Ladies and gentlemen, thank you very much for tuning in to tonight's webinar. Today, our topic is to explore purpose-driven investing, wealth creation with a positive impact. My name is Alexander Lee, and I'm Community and Events Manager here at iSTOX. And I'm happy to be the moderator for this evening. Just our typical disclaimer, just to tell you guys that anything that's shared in this webinar is not a call to offer, and nothing in this webinar should be fully relied on. We're very happy to have Panarchy Partners with us today. Panarchy Partners is a progressive purpose-driven fund management company headquartered in Singapore and the first fund management company to become B Corp certified in Singapore. Panarchy Partners was founded in 2018 by a passionate team of investment professionals who aspire to redefine wealth and how it is created. The diverse team had almost 100 years of combined financial markets experience with embedded sustainability specialists. So who is our speaker for tonight? Tonight, our speaker will be Munib Madni, the founder of Panarchy Partners. Munib started his career in Sydney, Australia, with the likes of Equilink Investment Management and Aberdeen Asset Management, and moved to Singapore with Morgan Stanley Investment Management in 2005. After leaving SMIM in 2018, he founded Panarchy Partners with a strong belief in the philosophy of Panvesting. Panvesting is the philosophy that he will be diving in detail today. I'm very excited to have him here to share his views and philosophy on Paninvesting. So thank you very much for being here, Munib.
No, thank you. Thank you for having me.
Before we begin, for those unfamiliar with iSTOX, I'd just like to share you some of our key value proposition, which is firstly, you get access to private investment opportunities, which were otherwise only accessible to the ultra-rich and institutional investors. Secondly, instead of the minimum entry of hundreds of thousands or even millions, you can access these opportunities at a much lower investment account via iSTOX. Thirdly, typically when you invest in a private fund, your money is locked up for years. By iSTOX, we have a secondary market where you can enter and exit your investments anytime and to provide additional liquidity. Lastly, you can enjoy transparent fees that will be clearly stated on the platform. Now, if you have any questions during the webinar, please feel free to ask them using the Q&A button below. It should be somewhere below your screen. It's just 2 chat boxes. And now, without further ado, let us begin this interesting webinar. Munib, the floor is yours. Thank you.
Thank you, Alex, and thank you, iSTOX, and also thank you for all the participants for taking time out, whether it be in Singapore or overseas. So today, I'm going to be sharing with yourselves how purpose-driven investing, we believe at Panarchy Partners, is the way for the future. It can not only deliver the commercial returns that we want, but also with impact. And with that, I am going to just share a few slides with everyone, if you could just bear with me. And Alex, if you can just let me know.
Yeah, we see your slides.
So you can see the slides?
Yes.
I always have this problem with, if you just bear with me. Sorry, I'm going to have to get out of.
No worries.
Sorry, I need to reboot my PowerPoint. Sometimes Zoom does this. It just ruins the flow. So if you can just bear with me. Sorry, I was watching Trump's inauguration while we were coming online. So
yeah, there's an interesting event that's going to happen soon tonight. I think a lot of people are watching.
Yes. So okay.
Yeah.
Are we back online?
Yes, I see.
Okay, you can see the Panarchy.
Yes,
right. So as Alex mentioned, after having done investment management since 1994 with the likes of Aberdeen Asset Management and also Morgan Stanley in 2018, started Panarchy Partners with the view to start investing in purpose-driven companies. And today I'm going to walk you through how that sort of evolution happened, not only for myself, for my team, and how we're executing on that philosophy of purpose-driven investing, and why we think it makes sense in the world that we're in now. So if I can sort of first share with you the cartoon that I like to share. And again, let me know if you are seeing the cartoon, Alex, just to be clear. All good. So this is a feeling that a lot of investors, especially investors my vintage, have been feeling for a while now. And increasingly, if they are still investing in their own traditional methods that even I was investing in 5-7 years ago, and for the last 25 years, a lot of institutional investors, and even you would say private investors, don't want to have this feeling. I didn't want to wake up one day and feel that I had made a lot of wealth, helped wealth creation for not only myself, my clients, but at the expense of the world, the environment, the society, human capital. And for that reason, I decided to go and start Panarchy Partners, and we evolved what we call now the Panvest philosophy. Now, one thing I would like to highlight is that this move towards Panvesting for us, or purpose-driven investing, this is, even though it might feel to many people relatively new, my research, and I'm a bit of a historian, I love history, reading history. When I went back in time and looked at how wealth has been created over the last few centuries, I realized that this is a natural evolution, what we're seeing. This is not actually in the scheme of a broader history. This is nothing new. And let me share with you what I've learned from my readings about wealth creation over the centuries, and how and why what we are seeing now is only natural. First, if I was to put the history in the form of a diagram, in form of a graph, most of us understand graphs better than anything else. So on the x-axis, I'm sharing with you how wealth has been created from a few people to the many over time. And what I'm going to do is share with you how, while that wealth has been created over time, what has it meant for environmental, human, social sustainability? In other words, the broader stakeholders that nowadays we talk so much about. And over time, you will find that as wealth has been created over time, we've seen sustainability around human, social, environmental increase. And we're almost at this plateauing point where everyone is scared that any more wealth creation, the way things are happening now, will see a dip, dive, collapse in sustainability. And that is the question we're all asking. If I go back in history and look at even at 1100 AD, when the kings and the conquerors were the only people who had money in their hands, we're talking about the time when Hatshepsut was the only female pharaoh, and you had various emperors and kings, Genghis Khan roaming the world. At that time, money was in the hands of the conquerors and the kings. Environment was undamaged. The world's population was less than 100 million, and social contracts were not even existing. As we move to 1100 to 1600 AD in time, this is a very interesting period. We started seeing improvement in social contracts. We saw Magna Carta, the very first legal contract between a ruler and the population. We started seeing improvement in actual health because of various medical technologies and innovations coming through. And we started seeing wealth going from the conquerors and the kings to the elites. And the elites were who? They were your traders. You had your bankers, the Medicis were there. You had even some of your artists, musicians, explorers, but they were still linked to the kings and the queens and the conquerors. We had, at this point, as we reached 1600 AD, for the very first time, the word investor came into existence. And this is an interesting question I like to ask all investors. Does anyone know, do you know where the word investor came from? And majority of the people don't understand where the investor word came from. So in 1600 AD, a little bit of trivia for you, when the British East India Company and the Dutch East India Company for the very first time issued their stock, which was over the counter, the people who bought them was walking around saying that this is a form of invest dire. Invest dire is a form of evolution from one form of good to another form of good, and was used in the fabric industry. So people who were giving money for capitalistic endeavors were always called a process of invest dire, and that's why they were called investors. So we had improvement in wealth, sustainability on the social side was improving, but we still were were not affecting the world economy environment that much. At 1600 AD, when we first became investors focused on financial returns, there were only 600 million people on the planet. That takes us to 1900, the period 1600 to 1900. All of a sudden, we started seeing elites joined by traders, colonizers, and even some investors and entrepreneurs coming onto the map as creating wealth. We had wealth democratization to some extent. We had social contracts improving, mostly through revolutions, actually. So while there was colonizers on one side, you also had revolutions on the other. There was wealth creation, there was improvement in health, and the world economy, environment was still not being damaged because we had not yet gotten into the fossil fuel area. In this period, the only thing investors cared about, and this is very important as we go forward, is returns. At this point in time, the concept of risk was not measured in the way we are now used to. And the only thing that entrepreneurs or investors cared about was financial returns. If we moved past 1900, this is what is now known as the Great Acceleration. This is an incredible period for mankind. This is when we had the greatest increase in population. We had the greatest increase in wealth democratization, the greatest increase in energy consumption, amazing increases in technology, in human sciences. If you look at our child mortality rates, went from 36% and dropped to 8%. This is also the period where the world's population went from 1.5 billion to 7 billion. And it is also the period where we see investment as we know it bring into this concept of risk. It's all around the stock market, it's all around benchmarks, it's all around indices. And investors became institutionalized courtesy of funds management companies and mutual funds, and the Investment Act of 1940s US made sure everything became very organized, regulated, and then with the mutual fund industry, investors became dependent on risk that was determined via an index. The question we have now, if we continue the way we are, only caring about return and risk on financial capital and not worrying about environment, human social stability, I fear, and most people fear, that by doing that, it will come at a great cost to a firm's employees, society, and the environment, and eventually shareholders. So the question for us is, how do we make sure that we still grow the pie for everyone, but do so in a way where we can measure returns, risk, and impact? And this is where purpose comes in for us at Panarchy Partners, and should come in for you as an investor investing for the future. Now, what is the implications for this practicality? This was all theory, this was all history. And history definitely needs to be understood for us to move forward. So the implication for investors is that we are moving from a shareholder capitalistic world where returns on financial capital and risk around and the protection of financial capital are the two most important things that I was trained at university. The whole CAPM model that we know is risk and return. There's no impact in there. So that is your shareholder capitalistic world. We are moving to what we call the stakeholder capitalism world. And in this world, what we are finding is returns on financial capital. Yes, people still want that. No one is saying returns should not be or should be foregone. But people also want to know what is the impact that their investments are having while they're making their financial return. If you look at the risk side, most people talk about risk and risk around not only financial capital, most people are looking at risks around environmental capital, human capital, and social capital. What we think is that if you find companies that are purposeful, these risks become opportunities. Environmental, the decarbonizing world, and carbon taxes, yes, they are a risk. But at the same time, companies that are actually enablers in a decarbonizing world is an opportunity. On human capital, employees development and training and employment is a very important issue for companies going forward, especially with millennials coming into the workforce with a big, large number. That is a risk. It is also an opportunity for any company that can harness the human capital and develop and deploy them smartly. Last but not least, social capital is another form of capital that we believe in the past has been outsourced to the governments, when it comes to unemployment, when it comes to social services, companies are bringing them in. And COVID, what we saw with COVID and how companies are stepping forward in delivery of services, even if it meant at the expense of shareholders for the shorter term, shows you social capital is another area where it's an opportunity. So we as investors are moving from a shareholder capitalism to a stakeholder capitalism world. We shouldn't be fearful if we are investing in purpose-driven companies. Those risks become opportunities for them. What is an ongoing challenge for all of us, whether we are asset owners, whether we are investors, or whether we be fund managers like myself? The collective purpose for all of us, at least in this space, if you're a doctor, obviously different, if you're a teacher, slightly different, but as an investor, is to generate commercial returns with a long-term view. That's been our purpose for the last 400 years since I mentioned we were called investors for the first time. But that purpose is now evolving for us. People want sustainability into it, and they want to know their impact. Now these are two very important things, factors that all of a sudden we as investors need to understand. We have not been trained for that. If anyone who went to university 25 years ago, even now, the risk return frameworks that we are being taught at universities now have not got impact and sustainability in them yet. It's coming. So what should be our aspiration as investors? Again, if I was to take the same framework of putting financial capital on the x-axis, and I put the human, social, environmental capital on the y-axis, there's a perception that all returns for investors sit on this spectrum of returns. Now, what it says here is that if you buy a uranium mine on the right-hand side down the bottom here, if you buy uranium mine at the right time in the uranium commodity cycle, you can have phenomenally high returns. But at the same time, the damage that it does to the environment and the society is fairly negative and fairly substantial. On the other side, if you invest in or donate to WWF, the World Wildlife Fund, is a negative financial returns.
Munib, you're cutting out.
Sorry. Oh, can you hear me now?
Yeah, now it's better.
Okay, sorry. So if you invest in WWF, that's a financial donation in a way, but the progress on human, social, environmental capital can be quite high. Often people believe that this is the only line on which the sustainability and financial returns sit. In other words, when you are making impact investing, your financial returns are low, but your impact is high. Renewables sit here. Thematic sits somewhere here. ESG sit here. And most of investments are sitting over here where people are trying to have high financial returns and manage their sustainability when it comes to progress on human social. Our aspiration as investors should be, how do we get here? In a perfect world, this is where we want to be, where we can have returns that are very high, financial returns, but at the same time, our impact and progress on human, social, environmental capital is also very high. And for that, everyone, all fund managers have their own philosophies, approaches. For us at Panarchy Partners, what we have is we believe that we need to evolve. As I showed you in that diagram, evolution is natural, it's needed. We need to evolve from being investors and investing and to invest to what we call Panvest. And we need to Panvest in purpose-driven companies. Now you will ask, what does Panvest mean? As a shareholder, to Panvest is to be vested in all, and Pan is the Greek word for all, 4 forms of capital. As I said earlier, for us, there are 4 forms of capital that a company needs and nurtures and deploys to actually deliver products, processes, services, and profits. And that is human capital, social capital, environmental capital, and financial capital. And for us, whoever treats these 4 forms of capital as assets, not expenses, that is what we call Panvesting. Now, many people say to us, but isn't this just ESG investing? And you could say, yes, ESG investing has the same sort of elements. But the difference is that ESG analysis focuses on risk mitigation most of the time, not all, most of the time. Panvesting treats the 4 forms of capital as assets, not just expenses. thus requiring progress and return on them. And what do I mean by that? And what should you be looking at when you look at companies? And I'll give you some examples here. As an example of a company that looks at human capital as an asset, if you look at SAP, the German information company, software company, they have created internally what they call the Business Health Culture Index. And this is an index that they have derived by doing engagement.
You're cutting off again.
All their employees.
I'm really sorry. You cut off in the last
on a regular basis. Oh, sorry. Yeah. Sorry, am I back again? I apologize.
Yeah, it's a bit choppy, your connection.
Are we good?
Not yet.
See if I can also. You can hear me or no?
Yeah, I can hear you. Now is good, I think.
Okay, so I can continue or? Okay.
Yeah, please continue.
I apologize for this. Okay. So SAP has the Business Health Culture Index, and they've worked out that with that index, and it's an index that they've created for their own human capital, and that is their own employees, that every time their index goes up by 1%, there's a 90 million euro EBIT enhancement. So they know exactly how to treat their employees, to make their employees happy, to reduce increase the retention rate, lower the churn, do internal hirings rather than external hirings, promotions as well. And that leads to greater returns financially for someone like SAP. If you look at the company like Zoetis, the animal health company, they actually, on social capital in Australia, they spend $5 for every sale that they get. They put it into Beyond Blue, which is a health services company for mental health in the rural areas of Australia, because there is a high level of depression and suicide in rural Australia. And by helping Beyond Blue provide services and health advice or even antidepressant advice, they are making sure that the rural communities in Australia, which also, by the way, are customers of their animal health care products, are healthy and sustainable. If you look at Train Technologies, it's a HVAC company in US. It has a very high carbon emission target, 1 billion tons of target removal for their clients over the next decade. That again is them using it as an opportunity and treating environmental capital as an asset. All of these show how it adds to financial capital return. So if a company has a purpose that is also satisfying the other forms of capital, that's the kind of company that you want to invest in, because it does lead to positive financial returns. Another way where we are and where we think Panvesting is different from ESG is that ESG, when they analyze these forms of environmental, social, human capital, it always is a point in time analysis. For us, when we look at companies, and when you look at companies, you should see how a company progresses over time. Don't judge a company for where it is standing right now. Judge it on where it's come from and where it's going in its targeting. So purpose as a strategy. Not many people use purpose as a strategy in equity investing. You have momentum strategies, you have growth strategies, you have value strategies, you have quality strategies. For us, we believe purpose is a strategy in itself. Finding companies that have purpose, it helps companies create long-term resilience. And how they do that is through actually becoming, they become disruptors themselves, such as Neste, the renewable diesel company. It also protects them from other disruptors. In other words, it gives them longevity. Purpose, if a company has good, strong purpose, it drives innovation and impact. Last but not least, and very importantly, purpose helps transform people, processes, and products. As I said, these are the things that a company needs to deliver good services and products and profits. So purpose as a strategy is very, very important if companies want to remain resilient, want to be innovative and impactful, and also keep their staff and society happy, thereby making sure their costs are lower as well. As an example, I mentioned earlier on Train Technology. This is a HVAC company, which is a heating, ventilation, air conditioning company. Normally, you would not associate this with sustainability, but when you look at a company like this, it has a purpose to boldly challenge what's possible for a sustainable world. Seems like a very fluffy purpose, but when I show you what they actually do, you can see that this is a company that believes that one company can change an industry and one industry can change the world. And how they do that is through their innovative products. They have created over the last decade, they've converted themselves from an air conditioning company into a climate control company because they realize that in a decarbonizing world, buildings that make up for roughly 15% of all carbon emissions globally need to have, especially building air conditioning makes up 15% of carbon emissions globally. They have a role to play to help their clients reduce that. And all of the last 10 years of R&D has been spent on creating eco-efficient, carbon-reducing technologies, which now they're deploying. And they have a 1 gigaton, which is 1 billion tons of carbon reduction for their clients. That is, on our estimates, a $50 billion value pool at a $50 per ton carbon abatement cost that most probably will be the norm in the next little while. So this company is not only delivering a great environmental, you could say, solution to their clients, it is doing so in a profitable way. And it's given them also a technology that has leapfrogged them in front of their peers. Now you might say, okay, making money is great, but what about purpose around society and the human capital? This is also a company that covers food for, food for poverty-stricken families, because they provide helping hand funds is one of the ways that they ensure that they keep their employees happy. Their CEO gives 30% of his salary, and other C-suite give us a reasonable amount of their salary to an internal fund, which helps their employees whenever they're in trouble, either because of family matters, health, or various other unforeseen circumstances. So a company's purpose need not be just for the customers, it can be around the society, and it can also be around their human capital. Now, does all of this lead to good returns? We think so. At Panarchy Partners, we have a way of measuring a company's resilience. And if you look at Train Technology, based on our analysis, they went from a score of 5 out of 20 in 2007 to 11 out of 20 in 2013 and 15 out of 20 for 2019 over the same period. And this again tells you that a point in time does not tell you a story. If you're doing ESG, you need to look at it over time. Our resilience analysis shows that this is a company that has been improving on the human, social, environmental capital. They have a purpose around that, and they're delivering on it. They have delivered on that when you look at their return on capital employed over the last decade as well, stable and improving. So the financial returns of a purpose-driven company can also be fairly good. And I'm not even showing you the share price and all the rest, but it's delivered some fairly significant and strong share price return as well. To finish off, what I will share with you is some of the areas that we are looking for ideas. I thought leave you with this, that often companies that we find are interesting are the ones that are solving a problem. They are solving a problem for the world, for the society. And that purpose, for us to identify that, we need to find companies that are finding answers for certain questions. And so there are certain questions that we as a team find very interesting for the next decade. And this would be things like, is purple the new green? Hydrogen's second coming. Anyone who follows hydrogen, from last year, we had a fairly interesting, you could say, bubble being created in the hydrogen space. Keep in mind, in 2000, there was a similar false start. So there's a question, is this second coming going to sustain? We think that there's few good reasons why this might sustain, but you have to be very selective. We need to find companies with purpose in hydrogen. Is aging a disease? Everyone thinks aging is a disease. In 2018, WHO actually, for the first time, said aging is a disease. In other words, it's curable. If it's curable, it has massive implications for pharma, massive implications for the society, for governments, for asset owners. That's something that we are also looking at. How does a company answer that question? And especially all the second knock-on effects of that. Where is the next digital dividend to be found? What I mean by that is everyone knows digitalization has happened in, let's say, telecom space. It's happened in services space. It's happened in retail space. It's happening in banks. But there's a whole massive space of industrial digitalization, which is only now gaining traction through IoT, through AI, through data science, through cloud computing. There are winners there, and companies with purpose in that area are very exciting. They're ignored at the moment. Everyone's running to the very optically impressive tech names. We think there are some fantastic purpose-driven companies that are, people don't think about them, but they're in the digital dividend for industrial space. Last but not least, how will companies, that went back to my question on recruitment of human capital. How will companies recruit, retain, retrain their human capital? That is very, I think human capital is most probably the least understood, least measured and talked about, and will become a really interesting point of discussion for any company's profitability in the coming years. And we are seeing that not only happening right now from discussions on work from home, how that affects productivity, how that affects costs, but forget that, even beyond COVID response, and let's say we all get vaccinated and we all are fine back to normal, how do you recruit, retain, retrain the human capital where we are going to have longer lives? I intend to work for the next 30 years. In the olden, 30 years ago, maybe I would have retired in another 10 years. How is the working space going to accommodate people like myself? Very, very important. So Alex, with that, I'm happy to stop sharing. Apologize for the interruption on 3G. As I said, happy to answer questions that you have now.
Thank you, Munib. Well, I really love the quote that you said just now, which is don't judge a company on the financials, but on its purpose. I think that really ties the whole presentation webinar together. We seem to have really many questions. There's 7 questions right now. For the audience, and you wish that there's some parts that you wish Munib to dive more detail into, please feel free to ask in the Q&A box below. Now, Munib, I just got a question. You said that in school, what they teach in school is really all about managing risk and capital. What inspired you to really make this switch? What is there a trigger that triggered you to change to this Panvesting mindset?
So there was no eureka moment. There was no eureka moment as such, Alex. It was a slow burn. And it was also a realization that I wanted, I've been working for 25 years in investing. Mm-hmm. And I've always been a student. And as I said, the chart that I showed you with the evolution, I'd been studying that for many years, thinking I would one day write a book on wealth creation and wealth management and its evolution. And when I wrote that, I realized there were 3 forms of capital that were completely missing: mm-hmm. human, environmental. And they were increasingly being discussed by not only consumers, they were being by producers, by regulators, by asset owners, by investors, and also by my kids, my children, right? So that kind of made me realize, okay, investing has evolved over time. As I said, 80 years ago, no one knew what a alpha was. There was no concept of alpha or beta because there were no indices to measure it against. Mm-hmm. What's different? So why can't we now have risk return with impact in our frameworks? So that's why it made me leave the comfort zone that I was in. It made me go and team up with individuals who were in the human, social, environmental capital. It made me go back to university and relearn. Learn for the first time environmental capital by doing a master's of environmental management at NUS. So having the conviction that this is something that's going to here to stay, I have got the experience of managing financial capital, but now I need to evolve to bring in the other forms of capital that up until now have been ignored, but increasingly cannot be. So it was a slow burn and realization.
Nice. Well, you said that your colleagues or even your children are suddenly interested in this sustainable trend. So is this trend, do you think, is going to continue? Is it going to last through the next generation? What are your thoughts?
Yeah, I think the words, often when people say trends disappear, It disappear because they become norm. And all of a sudden people say, okay, you know what, that's the norm. So what's the next trend, right? So in the same vein, I think 10 years from now, 15 years from now, ESG will, as a term, will disappear because everything is going to be put in terms of sustainability with environmental capital and capital and social. So if you're looking at a trend by how it is defined and whether that trend is how many times it gets mentioned in an article or a newspaper, then I think ESG will disappear. But if you think that it becoming a norm is going to reverse itself, no way. That's not going to happen. That genie is out of the bottle.
Okay. Yes, that's true. So you're saying that the trends will start fading into the new normal, and so it sort of disappears.
Yeah, and that's happened before, right? You know, and that will happen again. You know.
All right, great. Let's just dive to some questions from the audience. Let's answer this one. What benchmark do you use to compare Panvesting performance against?
Yeah, so benchmark is an interesting question because when you look at, again, when you go back to the history of wealth creation, if you look at even the history of wealth creators in the last, let's say 50 years of the likes of, you know, Warren Buffett and the rest, none of them invest with a benchmark in mind. They are investors in businesses. They've always been, right? Now they might have called it a quality, not a purpose-driven strategy, but so the great wealth managers and the great wealth creators, in my view, never had a benchmark. They only wanted good companies and delivered over a long period of time. So that's one answer, that if you want longer term wealth creation, I'm against benchmarks. I think you should have some kind of financial return expectation. Is it inflation plus 7%, double your money every 7 to 9%, have an absolute return focus. And especially when it comes to sustainability, that for now will be needed because there are no benchmarks out there that I can think of, and we've looked left, right, and center everywhere, that properly do justice to benchmarking ESG, investing, sustainability issues. I just think because if you look at any index, which by the way, benchmarks are based on, they are objective, they are always backward looking, and they are based on short-term frequent data points. If you look at sustainability, at the moment, sustainability is subjective, it is forward looking, and the data points you get on sustainability are not your 3 months, 6 months. Sorry, the third one was that sustainability is measured longer term forward looking data points at the moment. One day when environmental factors, social factors, human capital factors,
when you're saying something about
can be
human factors,
standardized.
You cut off at the part you say human factors.
Yeah. Sorry. One day when some of these factors can be standardized, now there isn't.
When do you think that one day will be? What would you need for that one day to happen? Okay.
So on the environmental side, it's going to happen in the next 5 years because environmental standards are becoming normalized. In 5 years' time, you and most investors will want to know what is the carbon adjusted PE of their portfolio. People will want to know what is the carbon adjusted EPS growth of their portfolio. It's going to happen in 5 years. So environmental standardization and benchmarking will happen within the next 5 years. We already are doing that with our portfolio. Social side will be taking a bit longer.
Okay. Yeah, that brings me to our next question by Diana. She asks, financial capital are quantifiable. How are the other three capitals quantified, and how would these three capitals one day appear in the balance sheet as well?
Yeah. So again, as I said, on the environmental side, we are seeing global standards like SBTI, which is the Science-Based Target Initiative, already confirming some of the carbon emission targets. So I think the environmental standards are already being approved by people like SBTi and the rest. If you look at human capital, like the BHCI that SAP has, they're being also investigated. Companies are putting a lot of effort into measuring human capital and its impact or return on human capital. So increasingly you are seeing companies doing it rather than regulators doing it. But environmental standards and factors and numbers, they're happening as we speak right now.
Oh. Okay, next question by Patel. How much of COVID-19 and its effects, especially economic, should have been realistically foreseen? And how much is actually a black swan?
Well, I think any pandemic, which is a one-in-a-century pandemic, would be classified as a black swan, if there is a classification. Economic impact, I'll be honest with you, as someone who's watched various bubbles, and I've seen, various crises, and I've watched many crises in my 27 years. This is one which, while feels the most impactful on a humanity side and on a, let's say, just disruptive side, the economic damage, I think, is still unseen. I think, the fact that Singapore has spent 100 billion in protecting a lot of the livelihoods here, US is just past a 1.9 trillion package, Europe the same. The economic impact of what has happened, we still have not seen, sadly. I think this is going to play out for the next decade, where the economic impact will take a long time to get through this. It'll be a slow burn.
Okay. Next question. Does sustainable investment cost more than non-screen products? Isn't it more profitable to invest in companies that do not focus on sustainability?
In the shorter term, yeah, go for it. I agree. But medium to longer term, see, here I think the definition of sustainability, if I may, the way we define sustainability is, in the past, companies used to outsource externalities. What I mean by externalities are extra costs around human capital. They didn't train people, the government did, universities did, everyone educated themselves, came and worked. And when I did my first degree, it was 25, my first degree was, and gave me 25 years shelf life for a job. Nowadays, it's 5 years. And if a company doesn't want to lose their employees every 5 years, they need to train them on the spot. So that human capital cost is being brought in now, or lose your employee. Same with social costs. In the past, it was outsourced to the society. Environmental costs was outsourced to the environment and to the governments. So the definition of sustainability to us is which companies are insourcing, bringing them into their business models now, so that when 2 years from now, 3 years from now, 5 years from now, they are forced to, their competitors are forced to put that into their business model now, the competitor is going to suffer. So yes, in the shorter term, companies are being, let's say, derated because they are saying my operating margins are going to be flat for the next 2 years as I invest in sustainability. But by doing that, they are ensuring that their operating margins from year 3 to year 7 are going to be much better than their peers, who then will be forced either through regulation, either through litigation, legislation, or consumer preferences, are going to be forced to bring in those costs. And I think that's where the question, the person who gave the question, they're right. Short term, you can make great money not worrying about sustainability. But if you are a long-term investor, and what I mean by long-term, I'm not talking about 2070, I'm talking about, like, even if you look at 5 years, I think within the next 5 years that some of those costs are going to be forced into companies earlier, and people who are investing in sustainability now, they will have better margins. So on a 3 to 5 year basis, they should deliver better returns.
Wow, that's I think you're being very generous when you said that the university degree lasts 5 years. I think nowadays is always a constant learning. Um, and then you mentioned that for long-term sustainability, the cost of the future is already factored in today. So that really brings me to one of these questions I find very interesting. So how does one effectively screen and find for these purpose-driven companies as an investor right now? How do we identify these companies?
Yeah, I mean, there are various ways that you can do it. And I'll give you one small trick of the trade if you want, that anyone can do it. I would just go and see, has the company done a genuine stakeholder engagement? And that you can do by looking at their sustainability report, their annual report, their integrated report. Have they done it? And have they identified what matters to their business and what matters to their stakeholders? If a company has done that on a regular basis every 3 years, you normally find that their board of directors and C-suite have a mandate which is all about being in the new stakeholder capitalistic world, as opposed to just shareholder maximization. So for us as a team, the very starting point, we will not invest in a company that has not done a stakeholder engagement or has not disclosed what are the relevant, most important issues to their stakeholders that also mean sustainability of their financial performance. And normally you find that when you've done a stakeholder engagement in the form of what we call the materiality matrix. So that would be my to-go-to, simple. Go and have a look at a company. If they've not done a stakeholder engagement, there's a good chance they don't know what truly their purpose is. Then they might have a purpose that might not resonate or might not be in line with stakeholders.
Well, sorry, I'm not clear, but I think some of our audience may not be sure to. What is the material matrix?
Sure. So if you look at whenever someone does a stakeholder engagement, the aim of that is to understand, what do your employees like, what do your customers like, your suppliers like, your regulators like, your peers like, your shareholders like. And by the way, shareholders are part of the stakeholders, consumers like. And then what the company normally does is, and some stakeholders might say for a telecom company, it's water, but then others might say it's actually privacy, pricing, inclusion, data, blah, blah, blah. So then a company puts in a matrix, most important from low to high in terms of their own financial viability on the x-axis. And then on the y-axis, they put in from low to high importance to their stakeholders. So the top right-hand quadrant is basically the material issues that the stakeholders of any company find very important for the stakeholders, but also the company itself believes it's crucial to the survivability, to the longevity of the business model that they have. And normally when a company does that, you should see that over 3 to 5 years, that material issues might evolve. In the case of, let's say, someone like a consumer packaging good, in the early 2000s, it was all about product descriptions, giving details of what was in the product. You move to 2010, it was about supply and sourcing. You move to 2015, it was about packaging, plastics, circular economy. So if a company does on a regular basis this stakeholder engagement every 3 years, it provides to their board of directors, their C-suite, their CEO, and therefore the rest of the team, a fairly good idea of what matters to their stakeholders and where it matters to their business as well. If they've done that, then on the back of that, they can create a purpose, which is aligned with what their history is, what their strengths are, what they want to achieve. And it becomes a bit more impactful purpose rather than just a flaky, non-measurable purpose. And the materiality matrix is basically an outcome of a stakeholder engagement. And you can go and look at any company, any company that has done a stakeholder engagement, they would have a materiality matrix or a materiality schedule.
Do you have some examples on this? Because the first thing that pops into my mind is when the Apple released their latest phone, they removed the chargers and wires. So there's sort of got a mixed reaction from the public, from the consumer. So do you think that is part of the matrix?
So I I suggest go and have a look. The last time Apple did a stakeholder engagement was 2014 or 15. They haven't done one for a long time. They haven't shared their result. So Apple, for that matter, a lot of the tech companies, they don't actually disclose if they've done a stakeholder engagement, what is the result. And for us, if I'm a shareholder, I'm a Panvester, I don't want to invest in a company that doesn't tell me what are their risks. This is no different from when I'm investing for financial capital. I want to know the financial risks. I want to know the financial opportunities. So why am I not worried about what a company is doing when it comes to their other stakeholders? So good question. It would be a great example for you to go and have a look and see if you can find Apple's stakeholder engagement, their materiality matrix, and see if that is up there in their right-hand corner, or is it down the bottom on the left hand?
Okay, that's some homework for me after this. Okay, I think that's all the questions that we have today. Really thank you, Munib, for taking your time to share. Let me just share my screen. So if you guys want to still contact us and ask me about iSTOX or continue conversation with Munib, these are our contact details. We do have a webinar coming up next week. So at iSTOX, we try to continuously share more new insights, invite new speakers to come aboard. Next week, we have a very exciting team from TMF. I will share the sign up link in the chat so that those who are interested, you can sign up. So really, again, thank you very much for joining us tonight. We look forward to see you guys in our future events. Thank you very much, Munib. I really learned a lot. We learned a lot about investing, about the philosophy, and I look forward to see what follow Panarchy Partners' journey, and we'll keep in touch. Thank you very much.
Thank you
Very much for coming.
Thank you, everyone.
Thank you, everyone. Have a good night.